All right, welcome back, everybody. Excited to bring you some new information on what's happening in the market. There's a lot of uncertainty right now, and I'm sure you're going to want to know exactly what's happening so you're always informed about real estate in the GTA and how that affects you. So let's get started and we'll get right into it. Uh, Everyone knows there was a recent drop on the rate. There was a 0.5% drop by the Bank of Canada overnight rate, which is great news for the market and the confidence of consumers because we've had a lot of buyers on the sidelines kind of waiting to jump back into the market. And recent data and surveys suggest that everyone is still waiting for these rates to go a bit lower. So sub 3% is kind of what the survey read, and that's well on the way. And we're working our way down. And the Bank of Canada has clearly indicated they're going to continue cutting. We're looking for potentially another half point in December with another 1 to 1.25% over the next 12 months. So that'll be good news for the market and just bringing all that confidence back that we've been missing. The Bank of Canada thinks it might create a bit of a frenzy. I mean, I don't know about that. It certainly hasn't transpired as of yet, but we're looking for signs of that going forward. All right, so with that being said, and the softening of the market, Royal LePage has recently updated its numbers, and they do think that it's on par, maybe slightly lower than where we were last year. We were expecting an increase this year, but that didn't happen. So they've adjusted their forecast. Is it finally the bottom? I mean, there's a lot of indicators that say it is the bottom, but there's a good news story to all this too. So we're going to get into some of the good news that's happening in the market as well. And a lot of that revolves around price stability. So as we look at resale buyers and how they gradually begin to move off, the sidelines, there was an annual increase over last year's 25-year low. So that's not great. And that's basically September over September. Okay, so there's a modest increase of 8%, but still well below the 10-year average, like 32% below. So yeah, we had a slight uptick September over September, but we're still well below that 10-year average. Year to date, our sales are down 3% compared to last year. We weren't expecting that. We were expecting a slight increase this year, and we haven't seen it yet. I mean, we still got a couple of months left in the year. We'll see how that goes. But it's the slowest January to September we've seen in 23 years. So very low in terms of sales, and we haven't seen this for 23 years. Sellers, they're active again, so we're getting a lot of listings, which is great. Those are above the 10-year average by a considerable amount. So, and the ones that don't sell, and I'll tell you a little bit about that, basically get suspended or taken off the market. They get terminated. And so new listings have surged 44% month over month. So we had the largest August to September increase in new listings on record. So we've got a lot of new listings out there, a lot of inventory, which is creating the market for a buyer's market. Having said all that, you'll see some stats that indicate we're not getting as many sales as we normally would, and we're below that 10-year average there as well. So compared to a year ago, the new listings grew by 10%, which was 14% above the 10-year average. So a lot of listings out there, okay? And so let's continue. If we go over here, we see the market conditions, how they begin to soften, it says here. Well, we're below that balance level, that 40 to 60%, the sales to listings ratio. That's how many sales we get out of the amount of listings that we have on the market. And it's only at 28% this year. It's very low. So that's a little below 1 in 3 homes that gets listed actually sells. That again, with the combined larger listings that we see, has created 5.1 months of inventory. That means if we stop listing homes today, we would move all the inventory in 5.1 months. That is definitely a buyer's market now. And it's creating opportunity for people that are jumping into the market. And you're seeing that with a lot of offers. So we're not in a situation where you see multiple offers and all that price kind of pressure. It's the opposite. People are taking their time, really looking at the inventory out there and making their decisions, well-informed decisions. And they come in sometimes with offers that are lower than expected. But that's what type of market we're in at this moment in time. The prices. Now, this is the good news part I talked about at the beginning of this presentation, which is we have price stability. This is really good. If you look at the chart on the left, it basically shows us that the pricing has been going sideways for the last few years. So it's kind of holding at that near that high level. 1,107,000 is the average price right now in the GTA. So that's pretty good actually. And the average homes are selling for just under list price. We talked about offers coming in. Those are the ones that sell at 99%. So that's not too bad as well on an average. There's different pockets, of course, micro markets, and you need to dig into all that. And that's information I'd be happy to provide. So despite the lack of growth over the past 3 years, average prices were 32% higher than they were 5 years ago. And they've maintained a 10-year average of 7%. This is all good news, okay? Because we've had a lot of reasons for our market to kind of, really retreat, and it hasn't. It's shown tons of resilience. People that aren't getting the money they want for their homes are terminating them and listing them some point in the future. So no one's really giving away their homes, which is great. That's keeping the price stable. Okay, inflation. This is a very interesting slide. So 2%, okay, is kind of their target. That's where they want it to be. We're actually well below that. And if you take out costs of housing like rents, mortgage payments, and things like that, we're at 0.4. We're actually in a deflationary situation right now, which is not what the Bank of Canada wants. And that is why they're now starting to take bigger, drastic measures in terms of lowering that overnight rate. They have a neutral rate on the chart on the right, and you'll see in red writing there, it says the neutral rate that they've set is 2.75%. That means that's the rate that the Bank of Canada has indicated is a rate that is not something that they're trying to stimulate the market or to try and cool off the market. That's the neutral rate, 2.75. We're at 3.75, which begs the question, why are we still at 3.75? Why haven't we cut quicker and faster? And the Bank of Canada really is trying their best to move that needle as quickly as they can without shocking the system. And they don't want to just drop the rates 1% overnight in one of their next, they're doing it gradually, okay? But again, that's their neutral. They need to be below neutral, which is why a lot of economists are saying, look, we're going to be near that 2% by the end of next year, or a year from now, because our economy needs help right now. We need to kind of turn it around and get things moving again. Because it just, all those rate increases that we saw over the last 2 years crippled our economy. And it created a lot of unemployment and other factors that you'll see in some of the following slides. Government, they're starting to reduce their immigration targets quickly. Same for temporary residents. And a lot of this has to do with absorption, in my professional opinion and what I've been hearing from other people. We just grew too quick, too fast, and we need to absorb that. And it's creating a situation where people are actually coming into the country and not finding the jobs that they were expecting, because we had a lot of employment available, 2 years ago, but that's quickly turned around, and our unemployment is starting to increase. You'll see on this following slide here, look at the GTA's population in the last 23 years. I mean, it's grown exponentially. We were near that 5.5 million mark. We're now near 8 million. That's a lot of new people to absorb in such a short period of time. And so it's taking time for us to absorb, all this extra population growth into our economy. And it's going to happen. It'll take time. And I think they're doing the right thing by scaling back at this point in time to allow for the market to absorb it. Okay, this is not a bright spot in the market. Our condo sales have fallen to a 30-year low. I mean, that is, to me, it's extraordinary, because with that population we've seen grow so much over the last 23 years, it just makes no sense to see our sales at such a low, because this is where people start in the market. It's the lowest cost housing that you can get into. You can get into a nice low cost condominium. There's incredible incentives right now. There's tons of inventory sitting on the market. Listen to some of this. I mean, sales are down 81% year over year and down 93% since 2021. I mean, that's just, it's fallen over, a cliff. The lowest quarterly sales we've seen since Q1 in 1995. That's a long time ago. That's 30 years ago that we saw sales this low. Year to date sales, they're below that 10-year average line by 77%. And we're on pace for less than 5,000 sales. We haven't seen that since 1996. So the condo market right now is definitely a place that there's a lot of concern because we have so much inventory. There's a lot of pre-construction units now that are also going to be coming online and exasperating that problem. So we need to move this inventory. There's been some interesting changes, government changes recently that may help that, and we're hoping to see that. But of course, the market will always take care of itself. It just may take longer than we all want. Developers are now slamming on the brakes on these new launches for this very reason. I mean, you can't keep bringing new construction online when we haven't cleared out this huge pipeline of inventory. And so the developers are definitely scaling back, and they're doing it drastically. You'll see here the costs. Okay, if you look at the overall costs to build one of these developments, I mean, a lot of the stuff kind of falls in line. You got your land value at the bottom there, that 20 to 23%, and you've got some of the hard costs in that green section just above that. And then we have some of the soft costs. Like these things don't change very much, but the government charges at 22 to 27%. That's exorbitant. And I think the government really needs to make some changes there because right at the top there, that last little slice, 9 to 12% is the developer's margins. They're not going to take this kind of risk and put a whole development up, knowing that their margins are not a little bit, cushioned for market changes. I mean, 9 to 12% is just not cutting it for them. And that's another reason that they're cutting back so quickly. And that'll change, I'm sure. Governments are going to realize, hey, we can charge 22 to 27% of nothing when they're not developing, or they're going to make some quick adjustments and realize, hey, let's adjust those costs down so at least we can help spur development again and make some money. Interestingly enough, you have to understand that every one of these projects, okay, as these completions are set to drop here, and you can see how they're going down quickly, each one of those cranes that we see in the sky in Toronto and the GTA, it's about 250 of them, still the most probably in any city in the world right now. But as those developments come to completion and those cranes come down, guess what? There's no new completions set after 27, 28. There's going to be very little development at that point in time. So we're going to have a little blank spot in our market coming up, and that'll create some amazing demand again in these condo markets that are at a 30-year low. That's going to swing. Things always swing back the other way. Well, that's what you can expect to see in the coming years. Notably, employment is a huge issue for us too, or unemployment, because every time a crane comes down and it doesn't go back up, that represents 500 jobs. So, if you do the math, it's pretty grim. We're going to have a lot more unemployment as these projects kind of wind down. More than 80% of investors now are in negative cash flow. So these are condo owners. And as you may have seen in some of my previous presentations, that represents almost 43% of the sales of all new condominiums are investors that are buying them. These are local investors, not necessarily international. And the cost to carry those units versus what they get in rent, they're at a negative cash flow right now. And it's gotten higher than it's ever been. And it's a large portion of these, it's 80% of these investors that are running into this issue right now. So that's turning them off from buying more units and investing. And, it makes perfect sense. Longer amortization. This is one of the government changes we talked about. It's creating more affordability. So anyone who's out there shopping and, takes a lower interest rate now than they did a year ago and amortize it an extra 5 years, that's creating an extra $665 of affordability per month on a mortgage payment. So that's really important. And I think that's going to help too. So let's see how that goes. Combined with lower rates, I think it's going to keep increasing affordability, and you won't see that negative cash flow for these investors now, and they may jump back into the market at that point, which I think is coming soon. Um, Key takeaways. What key takeaways are watching for the further rate cuts that are on the way, and how they'll impact balancing of the market. So neither will be a buyer's or a seller's market. Um, Another item to watch for is tremendous buyer's opportunities in resale and pre-construction condos. So I mean, you got to really look at this stuff right now. There's some incentives that have never ever been available uh, by developers right now for to attract new buyers for these units that are coming online. So that's obviously a bright spot. And even if you're buying resale homes right now, you'll see the inventory, like I said, is 5.1 months of standing inventory. So you can get into the market right now and find some great deals. Employment's going to be softening, as I touched on. That will be a concern going forward, but hopefully, we see some really impactful changes through government to help us get that back in line, and by the Bank of Canada as well. Resale housing market holding steady and strong on pricing, and so let's hope that stays. No one's forecasting that to change because I think the worst is now behind us. And with rates coming down and consumer confidence getting higher, I think you'll see that start to increase again, is what I believe. And good opportunities for buyers overall in the market, which I touched on earlier too. So thanks for tuning in. I really appreciate it. I hope you found this helpful, and feel free to reach out to me directly if you have any questions about your specific market.